Welcome to the complete guide to surviving the markets, focusing on risk management and trading psychology. This video is bound by rules and designed to help you preserve capital and build discipline and the right mindset. Our table of contents covers 6 key areas: why risk management, position sizing, stop losses and exits, risk/reward and expectancy, trading psychology, and finally, putting it together. 90% of retail traders lose money, and the reason is rarely strategy. It's risk management and psychology. The real reasons include over-leveraging, no stop losses, revenge trading, and trading without a plan. Understanding the math of account destruction is critical. Even a 60% win rate system has losing streaks. Large losses are exponentially harder to recover from, highlighting why capital protection is non-negotiable. The 1 to 2% rule is your survival mechanism. Never risk more than 1 to 2% of your total account on any single trade. This rule ensures that even a 10-loss streak is recoverable, keeping your emotions in check. Use position sizing formulas to translate the 1 to 2% rule into actual contract or share counts. Always round down to ensure you never over-risk. This is essential for both futures and options trading. Advanced position sizing involves concepts like fixed fractional, Kelly Criterion, and volatility-based adjustments. Implement daily/weekly limits and drawdown rules to safeguard your capital, especially during cold streaks. A stop loss is mandatory for enforcing the 1 to 2% rule. A hard stop is fixed and executes automatically. Other types include trailing stops, time stops, volatility stops, and a break-even stop. Stop placement requires skill. Good placement is beyond key support or resistance levels, beyond market noise. Bad placement is too tight, arbitrary, or moving the stop further away from entry. The risk/reward ratio determines long-term profitability. A higher RR means you can be wrong more often and still profit. For most strategies, a minimum acceptable RR is 1 to 2. It must be defined before the trade. Trading expectancy tells you how much profit you expect per dollar risk. A positive expectancy indicates a profitable system, so keep executing it. Express wins/losses in R and aim for an expectancy ratio above 1.0. It's vital to know the minimum win rate required to break even at each RR level. RR matters more than win rate. The best traders typically win 40 to 55% of the time with RR between 1 to 2 and 1 to 3. Now we move to trading psychology, the mental game that truly separates winners from losers in the markets. This involves mastering your emotional responses to risk and reward. Fear is a silent account killer. It shows up as hesitation, cutting winners too early, or avoiding trades after losses. To handle fear, accept losses as part of the business, focus on the process, and use small position sizes. Greed makes you overtrade, over-leverage, and ignore exit rules. Combat greed by predefining profit targets, sticking to your plan, using a flat daily P&L cap, and keeping position sizes consistent. FOMO, or fear of missing out, leads to chasing trades and bad entries. To handle FOMO, remember there is always another trade, and missing one costs nothing. Only enter trades that meet all of your criteria. Revenge trading turns small losses into catastrophic ones. Break the cycle by setting a hard daily loss limit and physically stepping away from the platform once you hit it. Review your trades tomorrow with a clear head. Discipline is the foundation of successful trading. It means taking setups even after losses and not taking trades when conditions aren't met. Build discipline by having written rules and tracking metrics like how many trades followed the plan. The trading journal is your most powerful tool for improvement. Record key trade details, including emotional state and RR achieved. Review your journal weekly to identify your best and worst performing setups. Awareness of cognitive biases is your only defense. Common biases include confirmation bias, recency bias, loss aversion, and overconfidence. These psychological traps can easily derail an otherwise sound trading strategy. Emotional detachment from P&L is crucial. Hide the P&L during active trades and think in R multiples, not dollar amounts. Focus on the process. A losing trade where you follow the plan is a good trade. A consistent pre-market routine puts you in the right mental state. Review overnight action, economic calendar, and key levels. Mentally prepare by reading your rules, reviewing recent trades, and visualizing proper execution. Post-market routines drive growth. Log all trades immediately, calculate daily R, and rate your discipline. Afterwards, step away from screens for a physical and mental reset before preparing for the next day. Handle drawdowns with a protocol. Reduce size after a 5 to 10% drawdown, and stop live trading after 15 to 20%. The goal is survival, not quick recovery. Never increase size to chase losses. Here are 10 rules for risk management. Crucially, never risk more than 1 to 2% per trade, always use a stop loss, and define risk before entering. Capital preservation must always come first. These are the 10 rules of trading psychology. Remember to trade the plan, not the P&L. Focus on process over outcome, And understand that discipline is your ultimate edge. Use this template to build your personalized risk management plan. Clearly define your max risk per trade, daily/weekly loss limits, position sizing formula, and minimum RR. Commit to your revenge trading protocol. In summary, risk management is paramount. The 1 to 2% rule keeps you in the game. RR is more important than win rate. Master your psychology, journal every trade, and always prioritize capital preservation.